What's the number one Greek that you should focus on when it comes to trading calendar spreads? A lot of people get this wrong. They're focusing on one thing when they should be focusing on something else. And I'm going to share with you some insight on one of the classes we just recently did in the members section on our calendars deep dive. So if you're new here, I'm Sasha, the options coach. I've been teaching people to trade options over the last 7-10 years here. And we did a class, calendar spreads deep dive. And if you're interested in that, check out our website. You can see this class along with tons of other classes here that I've been doing recently. Anyways, one of the things and focuses regarding calendar spreads that a lot of people do incorrectly and wrong is they're always focused in on the theta because they're looking at the theta or the time decay, but this is incorrect. This is the wrong thing to focus in on. Yes, this is part of it, but what you really want to do and look at is looking at the theta to vega ratio, because this is what's going to probably be a bigger Greek for you when trading calendar spreads, unless you're trading a short duration calendar. When it comes to trading calendar spreads, a lot of times that vega is going to be a big issue and problem. And here's what I want to show you is here's some trade examples when it comes to trading calendar spreads that we are running through the class material here. And I want to show you one of the calendars. And I want you to zoom in here and look at the theta to the vega. So what happens is the Greeks here that we have, these are your money makers. They are also your risks. Okay, so because they are your risks, they also make you money. So what happens is you have to pay attention from them from the sense of, okay, well, what's my risk? What's my problem? Well, this right here, these are your price risks. Okay, this is your kind of time risk, and this is volatility risk. Now, each one has kind of a risk and a benefit, right? So if we have the price risk here and it's pretty much neutral, we don't have to worry about that. Time risk, as you can see, or time benefit in this case, is much smaller. So what's our biggest one? The biggest one is the vega. And you can see the vega is almost, double the theta, almost 3 times, not quite 3, but about double, 2.2, 2.5, the theta. So even though a lot of people go into calendar spreads thinking it's a time-based trade, I'm doing non-directional trading. Yeah, I'm making money from time. That all sounds good and great. But the thing is this is actually a vega trade. And if I stack other calendars in here just to show you what's happening, here we go with a 593 and a 593. You can see also another theta to vega ratio, again, about double that, maybe a little bit more than double. And then we have another one over here that's also very similar. That's the vega is a little bigger. So as we start stacking more calendars in there, and we've got a handful of calendars, you can see my theta to vega, my theta is about half the size of my vega. So in fact, actually, if I drop this volatility expansion out and the volatility compresses, okay, I'm actually losing money right here. And now when I've lost $30, because we've got about a 3-point volatility drop, because on my vega is 11, right? 11 times 3, it's about $30. So I lost about $30 there. How many days does it take to make that up with theta? Well, it takes about, maybe 7, maybe 8 days or so, because theta does pick up. But as I start moving this forward, it takes 1, 2, 3, 4, 5, 6, 7, 8, around there, then you'll be back to breaking even. So it's important you really realize and recognize, hey, what is my ratio in these positions? And when you start looking at the calendar spreads here and you start saying, okay, well, here's all my calendar spreads because this is the kind of grouping that I have. Well, what's my theta right here to my vega ratio? And in some cases it may be fine, but in other cases, look, you might have a different ratio relationship, and which means if the vega is a problem, like right here, this trade right here, that's the meta trade I have. Okay, this trade, my theta is a 4, but my vega is a 22 and my delta is neutral. So that means that it takes about maybe 6, maybe 5. It's a 5x difference in that ratio. It may take, maybe about 4. It takes maybe about 4 or 5 days to make that up if there's a vega problem. Okay, in this case, this one may be about it's a 1 to 2, so it takes about 2, maybe 2.5, 3 days to make that up. So each one's going to be a little bit different. This one has a bigger theta than vega. And in this case, it's not, the vega is less of a concern. So paying attention to your Greek, oftentimes you're going to have a vega issue when it comes to calendar spreads, and you'll want to watch that vega and volatility. That's the number one Greek you want to focus in on. I mean, this is what we dived a little bit deeper here on calendar spreads in the class. Anyways, hope that helps, gives you a little insight. Check out some of the classes on our website if you're interested in deeper learning and really understanding what's happening and going on. Truly appreciate you joining me. Hope you got a lot out of this. feel free to check out our other videos on our website as well. Anyways, thanks for joining me. I'll see you on the next one. Take care.